Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. We've had 2 weeks off with Thanksgiving in between. We hope you guys had a great Thanksgiving. Today is Friday, December 3rd, 2021. S&P 500 is currently sitting at 4516. I'm David Zarling. I'm here with Dan Flashes, Ian McMillan. A lot has changed in the past 2 weeks. Let's hit it. Where should we start?
I ain't going to be shopping at Dan Flashes buying $400 shirts if stocks don't start going up.
It's an aggressive store.
It's an aggressive store. It really is.
So we've had some important information, right? We're always talking about information develop over the past 2 weeks from the market. What do we got? What's changed from?
A lot of change, right? So we talked about for months that the Russell is the most important chart, right? And where we went out of this consolidation would be a big clue as to where the broad markets went in the coming months. And maybe even the coming years, at least the coming weeks and months. And we broke out.
Right. We talked about IWM 234. How many times?
So IWM, or we can use the value line geometric average, which is another look at kind of the average stock in the stock universe. So both had the same type of range, both break out. Okay. So from a technician's perspective, the coast is pretty clear, right? And we can only go on the information that day by day, the information that we have. Breaks out, continues to go higher. Since that, we have seen that, unfortunately, reverse course, small caps back in the range that they've been in, and back to actually the bottom of that range.
Right. So we broke above 234 on IWM, representing small caps. This was potentially signifying the ongoing continuation of a trend for stocks broadly, not just the S&P 500, not just the NASDAQ. Right. Something like.
And it was right. So this this was a very technically sound confirmation. You had seasonality in your favor. We're breaking out, strong move. Hey, looks like it's going to be 2020 Q4 all over again. Great. Everyone's happy. And this is why we follow price, right?
Yeah, absolutely.
Did not pan out. And we are back to, we got back to 213. I know the bottom of the range, I guess, technically 211 to 210, but hey, failed moves. From failed moves come fast moves. And that's what we have seen over the last 2 weeks. And breadth has continued to deteriorate. And that was kind of one of I believe we mentioned this on the last podcast, but that breadth overall for the Russell and that breakout was definitely less than stellar. Not as good as we saw last November. And a lot of that was biotech, which is a super important piece.
Well, if we can paint the picture, right, because we do this on a weekly basis, but basically since February, we've seen this deterioration in breadth, which is just a fancy way of saying participation in the majority of stocks. So outside the S&P 500, outside the NASDAQ 100, what does this look like? Well, when you look at small caps, we had that breakout above 234. But like you said, from a false move or a fake move comes fast moves. We reclaim to the downside 234. And we're back to price levels at IWM that we haven't seen since February. So we haven't seen since January 2021. And then you go further down the spectrum or in size and you look at microcaps. And today, they're breaking a really important level around 136. And so you've had this really strong deterioration in stocks from February and through now. And the S&P 500 and NASDAQ have done a good job covering that, making it seem like it's not that big of a deal. Now,
they have.
And
I'll tell you what, you look at, just if I can add this real quick, because I don't want to forget, we talked about breadth and talked about participation. Something that's really caught my eye over the last 2 weeks from is this better or worse than what we've seen since last March? We know last March it's probably going to be one of the worst extremes you can have. And we've had other blips on the radar that are similar to this in price, a little 5, 6, and I think the Russell's down like 12% off the highs. But we've seen things like that happen since last March. One thing I want to point out is stocks with a daily RSI below 30. So pretty bearish reading, right? Being oversold. Off the chains, by far the worst that we've seen it since March.
Since March of 2020.
Yep. I mean, you've got NASDAQ. As of Wednesday, almost a third of stocks in the NASDAQ 100 were oversold on daily RSI. That's horrible.
And so let's touch base on two points here for someone who might not be familiar with. So RSI is just a measurement of momentum. And
yes.
When you say oversold, many that aren't within the industry or understand necessarily the school of technical analysis would say, oh, Ian is saying there's a lot of things oversold. That means the correction's almost over, or some type of correction's almost over. But what you're really saying is that is actually describing overwhelming supply.
Yeah.
Overall.
Stocks and indices and good markets don't get oversold.
Correct.
There's never enough selling pressure to get them there. Like being oversold, yeah, maybe and I'm sure statistically true. There's some type of short-term bounce, but right, and we're using 70. RSI can go from 0 to 100. It rarely reaches below 20 or above 80. Those are pretty strong readings. I think Viacom had like an above 95 on its run earlier this year. So you did get those extreme ones. But so above 70 overbought, we love to see that. We like to see stocks and assets and indices that continue to get overbought.
Right. There's nothing wrong with overwhelming demand, but you're saying this is the flip side. This is the other way, overwhelming supply.
And even when those indices sell off and correct, which is normal and healthy, we like to see them not get below that 30%. They're two lines in the sand. And it is what it is. That's what the industry, the kind of industry is chosen. So, some people, like I've seen people say, well, it got to 31 or 32, so it's technically oversold. I don't really play that game. I mean, you kind of have to draw a line in the sand somewhere. So you can't just always say, oh, well, technically. So 70, 30. And yeah, I mean, it's not good. And the same thing you see it in the Russell, you see it in the S&P 500.
As far as like the constituents of the S&P 500, of those 500, technically 505 stocks, there's less and less participation.
You've got communication services, consumer discretionary, consumer staples, healthcare, industrials, real estate, and tech all the most overbought, sort of a percentage of their constituency that they've been since any of this, since last March, since we started the recovery. So it's brutal. It is brutal out there.
It's super narrow. And what I mean by narrow is there's a select group. If you're not tilted large cap growth, the rest is pain.
And that seems to be the defensive trade. I mean, staples continue to underperform.
Well, and it's
utilities.
It's one of those. Yes, correct. It's one of those things where there's liquidity in the bigger names.
There is. And if you are nervous, if you're a portfolio manager and you're nervous, and I'm talking, these guys that, manage billions of dollars. If you're nervous that you might have to get out, are you trying to mess around in these small cap names that trade 200,000, 300,000, 400,000 shares a day? No.
Nope.
No.
Exactly right. And that goes back to, micro caps breaking below an important level today. So far, we've got a little while to close.
Chart. But and right now you wonder, are we now foreshadowing what's next to come for small caps?
Yeah, correct. Because if you go the risk spectrum, right, and you just say, let's put micro caps most risk on the left-hand side and large cap all the way on the right-hand side, and that's less risk. If we're seeing a shift, right, we're we're piling into these liquid names, selling off these microcap names. That's a risk off type scenario. Now, there's other things we can use to measure risk on, risk off, like a discretionary versus staples type ratio. And yeah, that had broken out back in October, but are we seeing that roll over now? That's to be determined, but today is not a great day for that risk on, risk off
And
relationship.
microcaps never broke out.
No, that might, yeah, correct. Where IWM broke out of this 8-9 month range.
Microcaps never made it. Now they're the first to get that breakdown out of this channel. I mean, they're kind of been, I guess, a little bit of a leading indicator. So, well, it's not a great look. And I mean, we've had multiple days where we've really, in our team discussions have talked about stocks they've got to really step in here and save themselves. So we're going to continue to have to raise cash. And it's just amazing kind of how that natural process works.
Talk about that a little bit as far as raising cash, trimming positions, and the natural process of that. Can you kind of walk through that, paint that picture of risk management for those listening?
Well, I think if you have a process of, and ours is clearly, a trend following process, and being involved in things that are going up and avoiding things that are going down.
Relative strength.
if you are selling your positions as they continue to go down, and right, for the most part over the last 18, 20 months, you're selling something, there's been other things to rotate into.
Right, because you're talking about relative strength and opportunity cost, meaning something on a relative basis versus S&P 500 is breaking important levels.
You're rotating out of growth, and then and that kind of naturally happens, right? All this stuff happens naturally based on your rules and your process. I'm selling things that are, either going down on an absolute or relative basis, and I'm buying things that are going up on an absolute and relative basis, and really no predicting. But when you get to these points where you continue to kick things out of the portfolio, and then there's nothing to replace it with.
Yeah.
Right. And so that's kind of how this natural, Dave and I don't go into the day or the week saying this is our cash target, or we want to be X% exposed by the end of the week or the end of the day. That's not how we operate. It's things get put in the portfolio based on a process, things get taken out based on a process, and sometimes things get taken out and there's nothing that meets the requirements to get put back in.
Right.
And before you know it, you look at your cash balance and
there it is.
It's a lot higher.
Yeah. Like you look at your candidates that could potentially be in the portfolio, and if you don't deserve to be in the portfolio based on your weakness or relative strength, which is opportunity cost, well, we rather own cash. And just like you said, then we're going to own cash. Cash is a position too. Nothing wrong with that. And especially when you start seeing different metrics confirming all this, right? All that's confirming is the narrowing. When a really aggressive strategy or like our ultra growth model buys treasuries, that's information.
Yeah.
Like,
did I buy treasuries this week? Are you kidding me?
Right. So,
and I'm benchmarked to and obviously growth got some as well, which is, I would say, also pretty rare for growth.
Yeah.
I don't think we've ever, maybe March 2020 we had them, right?
Right. Which is a scary month to say, March 2020.
Yeah. And we're not prepping ourselves, right? I want to be clear that it's not
correct.
We're not prepping ourselves for March. This has happened because of a natural selection. Now, if the markets continue to go down and bonds continue to go up, it's not us predicting that was going to happen.
Right. When we look at the relationship of TLT versus S&P, and you reclaim an important low, and you've got this decently sized momentum divergence using a measurement like RSI, it's worth putting some money to work there. And to see that confirmed, at least so far today, that's risk-off type behavior.
What do we talk about, right? We want to own things that are beating our benchmark. It's hard to beat your benchmark if you don't own things that beat your benchmark.
Yeah, if you want to have strength, you got to buy strength.
And we come on this podcast every week and we talk about, like, we are literally willing to own anything that we legally can here in the US that is traded and we can get access to.
And is liquid.
And is liquid enough, right? Which I would say is a pretty big difference from 99% of your RIAs out there.
Sure.
And financial planning and wealth management firms. But when we say we are literally willing to own anything that's beating our benchmark, people say, well, you're not going to own bonds if you're benchmarked to the S&P. Yes, I will.
Yep.
I will own treasuries just because I have an equity index.
We'll own coffee. We'll own cotton. We'll own treasuries. Doesn't matter.
How long I've owned, I didn't even know this was a thing. We've owned carbon credits for 3 weeks. I don't know. They keep going up, Dave, every day. So, it's what the chart tells you to do.
Exactly. When
now
you're
we're
studying,
up 20% on carbon credits, which I didn't know a month ago existed in an ETF format. But
they do, and they can be measured against something else, and that gives us our information on relative strength. So why fight it? Why? And that's like maybe a whole nother podcast on, why fight the trend. And that probably just simply goes back to pride. But, and I don't want to, I guess, from a tone perspective, I don't want us to come off overly negative, but I will say that our opinions are loosely held, right? The chart surpasses our opinions.
Dude, you get Russell back over 234. I'm totally willing to.
Yeah, man.
Like, come on, let's do it. Let's get bullish. But weight of the evidence says
caution.
I mean, right? I'm watching. We got as we speak right now, indices. I mean, they continue. I mean, these lethargic. We have had intraday lower highs and lower lows. It looks like we are on pace for yet another lower low on both the NASDAQ and the Russell and the S&P. You've got the Dow outperforming today, which I would say is a little flight to safety-ish.
Well, and I think, Ian, there'd be people who are like, wait a minute, you guys kind of sound like you're bearish right now, and we're only 5% off the highs and something like the S&P 500. What's your deal? But it goes back to the weight of evidence, right? It goes back to, we talked about small caps below 234. IWC, this micro caps did not break out, and it's breaking down today. The percentage of stocks that are now below their 200-day moving average is a little bit bothersome. The participation is extremely weak. Now, it can flip the other way. All these things could take over.
Yeah. I'm totally willing to be sitting here next Friday, and we are
back to aggressive,
back to super aggressive long, and we own semis, and we still do own a little bit of semis, but we own, we're back to owning transports and Meta and whatever it is, banks, exploration, whatever these, whatever pops up to the surface. But there's nothing popping up to the surface right now.
Well, and the natural process that you talked about before with relative strength and things getting eliminated, but then there not being options to add back in, it will be very obvious on the flip side, because there will start to be, plethora is a strong word, but there'll be a lot of things that will show themselves as opportunities that can be added back in that will match the breadth. Like the adaptive process by natural selection gives you information. So if we're getting more aggressive, it's because the data shows to get more aggressive, and then we'll probably be seeing a broadening out.
And here's the thing is, going back to your 5% and this scaling out of things, and then going back to, if we need to get back in, it will be obvious. And that's kind of I would say that Dave and I are okay with scaling out of things closer to it, especially with the evidence we have, because we are definitely willing to buy it back.
You can always buy it back.
Yeah, there should never be any shame in saying, oh, look, this seems like it's reverse course and going higher, and I need to own this again. And I've learned that the hard way, and I've had some great wins by buying back in as well. But it took me to the point of getting stopped out and then watching it get back above my original breakout buy zone and then continue higher. Right. And eventually you only willing to bang your head on the wall so much until you
Well, airplanes
say,
aren't
"Hey,
meant to
I'm
be
gonna start buying some of these back."
right. Airplanes aren't meant to be flown once, but they are meant to take off and they are meant to be landed and then used again.
Yeah,
So
I like
the
it.
idea that you have to own a stock nonstop is a little bit irresponsible, because what are you going to, you're just going to keep owning it when it's down 30, 40, 50%. You brought up Viacom before. You're just supposed to own that.
I mean, look at Robinhood. I mean, it's
Right. Marijuana stocks,
marijuana stocks, right? And
software stocks.
I was right there. I took a swing at cannabis stocks when the evidence said, and then 2 days later, I was done with it. And in the 3 weeks since then, they've continued to get annihilated.
Well, in, former leaders like software stocks, like PSJ,
The small cap growth is,
well, and this, I think there's a little bit of a clue there from convertible bonds, right? Some like an ICVT, that credit was, that type of credit instrument was tilted towards these aggressive software stock names, and that gave up some really important levels prior to something like ARKK giving up important levels. And so,
how about staying in the credit zone? How about these spreads that have broken out?
Yeah, let's talk about that, because that is one thing we like to look at. Is there is something to be learned from the credit market, right? Because markets are built to run off liquidity, like that's the oil of the engine. And credit spreads falling, more liquidity; credit spreads rising, less liquidity. And here we are in an environment, and I think you're talking about triple C bond spreads, Ian.
Yeah,
we've got, I even hate to use this term because I'm not really a big the golden cross. You've got in that spread, you've got a 50 and 200 day crossing above each other, which means you've got trends turning up in credit spreads. Maybe we're seeing a little tightening here.
I think it would be dumb to ignore what we've seen happen over the last few weeks there. There's right. We've talked about this, kind of the classic adage of the bond market is smarter than the stock market. I would say I don't know if that's true, but things like this can be a great leading indicator of, what is to come. And so to see spreads widen, like, how would you describe what it means when spreads are widening?
I would just describe it as shrinking liquidity, less oil in the engine, less risk taking. Mm-hmm. But if you've got that spread rising, if you've got liquidity tightening, that's harder on the engine, right? Like, just like your car, if you're low on oil or the oil change is overdue, that starts to cause the engine to seize up. And it's not as quick as an engine, right? Like, the analogy breaks down there, but in markets, the same applies, that if liquidity is falling out of the system, right, that's going to be trouble.
As yields go higher, right? We like to see yields go lower, because to me, it says that people, and I don't know who does this. I don't know who goes out there. I'm not a fixed income trader. My father was for decades, so maybe I should ask him this question. Who sets? We know the market. We know market participants set these yields, but when spreads are going down, it says to me, hey, I don't care really what the risk on the company is from a cash flow sentiment. Doesn't really matter to me if they're good or they're bad. Give me, 6%. But as they go higher, to me, it says that people in the bond market are now saying, oh, okay, well, to take this same risk, now you're going to have to pay me 12%. And so then they start to differentiate. What are the ones that, like, what are these companies that we really need to be being paid a larger cash flow to take the risk? So it's almost like, it says to me that people in the bond market are starting to pay attention more to the overall risk and what they're willing to be paid.
Yeah. And
you don't want to see that go out. You don't want to see someone continue to say, now you're going to have to pay me 8, 9, 10, 13% to hold the same bond. Because what's that? Then clearly they're seeing some type of something has changed on that end too, right?
Right. Correct.
I don't know what, but I can tell in price that it's changed.
Something has changed, that someone's not as willing to own that thing, or the issuer of that credit to that company is not willing to let that money be with that company for that rate.
Mm-hmm.
And
or
now,
I think it goes back to your perfect example. I think you actually hit it. If we want to use, supply and demand, it's no one wants it. And now you've got to incentivize people with higher yields to come in and buy this. And that is not risk on information. Correct. Risk on is when they don't care. They just want to own it because high yield bonds are moving up.
Exactly. And interestingly enough, we've got treasuries heading higher, which is that yield falling. And so, the 2/10 is falling. But what's important information is that we're seeing the risk on area of credit becoming more expensive, and the spreads are blowing out. And that's not okay. Hold on. Let me correct that. That's blowing out is too extreme. They're rising. And
at places we have seen bottoms over the last 20, 30 years.
Right. Here's the thing. Again, we're 5% removed from the highs. I don't want it to be like it's over, like everything's done. We need small caps to hold this 211 area. We need micro caps to reclaim their prior lows. Let's call them, 136, 137. We need to see a broadening of participation, not a narrowing. These are these are the characteristics of a healthy market. And what's interesting is, how much 2 weeks changes things. I think back to last week, and holiday weeks are notoriously low volume. They notoriously shake people out, but we didn't recover from that. Right. So last Friday,
it wasn't necessarily a shakeout. I mean, it was a continuation this week.
Right. And like the way we closed, like if we look at monthly information, and this is from Steve Depp, so November, we traded up 3% in November only, and it was all-time highs, but actually closed the month down. So we rose as high as 3% during November in the market.
Such a bad candle.
And then
such a bad candle.
Flipped back, and it's only happened 2 other times since 1970. Now his data, he pointed out, but he was also very clear, like it doesn't mean anything for this current month, but he just pointed out that those 2 times since the 1970 saw the market.
And was one January 2020?
I believe so. I'd have to look at or
maybe February 2020 is what we're
right. February 2020.
February 2020.
But could we see follow through in December? Now, this goes into the whole price versus news thing, which most know that we believe price comes first, then news reports it, similar to wet streets cause rain, not the other way around. Rain causes wet streets, not the other way around. And so is there news that we don't know yet? It's possible that there's some type of event that we don't know yet. And that's why there's institutional selling. And right, because everybody else is an expert. Everybody else is talking about vaccine mandates, supply chain issues, inflation. These are all the known knowns. These are already the bricks we know that are in the wall of worry. But if we start to see the S&P, if we're looking at S&P 500 and we see that, now this is not a ways off, but if we're below 4,300 on the S&P 500 a month or two from now, I'm guessing that there's some type of news that comes out that we don't know about currently, right? Because a lot of this other stuff is already known and priced in. Now that's another, I believe, 5% from this point, maybe 4 to get to 4,300. Maybe we don't necessarily need to do that. I don't want to do that, but I think that goes back to your comment, Ian, several podcasts ago. Like no one's really talking about the 10% correction anymore. And wouldn't you know it, could we have a 10% correction that takes us to 4,300? You could, and it'd be normal.
It's gonna be painful.
It'd be painful. Yeah, it's it's always easier when markets are going straight up. But if you've got
4,300 we'd have a lot of squeamish fish out there.
For sure. And it'd be a really interesting way to end the year. It'd be right at the 200-day moving average currently on something like the S&P 500 would be a perfectly normal place to test. If we got that far, I think it's notable. You have 2 sides of the coin on seasonality, right? Your May to October was what I would call unseasonably strong. Like it wasn't as
Yeah.
weak as what we've seen. But on the flip side, November, which is supposed to be one of the strongest months, was the opposite. And so you have to take that most recent data and maybe weigh it a little bit more than the prior data, right? We're Bayesian. So the newest data is at least in our profession, is going to carry the most weight. And a November that was weak when it's supposed to be strong is.
Yeah, stocks should. History tells you stocks should be going up right now. Now, we still can get a Santa Claus rally.
Absolutely.
We still have some good things coming up in January right now. Well, I don't mean to get 4 weeks ahead of us, right? Because maybe this maybe this is low, and on Monday, like I said, we're scrambling to buy stocks, and
right, because we're all we are is hovering around the 50-day moving average and something like S&P. We've had 5% off the high. Let's not get away from ourselves, other than recognizing the things that are the majority of stocks are in pain territory. But you're right. We could be back here next week and talking about how this was a great test of the 50-day, and we're grinding higher with seasonality going into January of next year. I don't know which scenario is more likely. All I know is that there's a red flag with what November did, but we still have seasonality to look at, and we have a rising 200-day, a rising 50-day. It's possible to see.
Yeah, this. Well, and you've lost. It's gonna be really hard. We've certainly, with the strong downward action that we've seen, we have put ourselves certainly positioned to see a bounce. And it's a pretty significant bounce in a lot of these areas, individual names and ETFs and indices, and not really fix anything. So, you've got Microsoft has lost the 330 level. It's not a great sign.
Right. When your market leader.
Apple is still above its September highs at 158-ish, 157-ish. But tech heading down on tech, if tech wants to head down lower, it's going to be.
It makes the rest of the market traction a little harder, right? If your large cap tech is moving lower, it's really hard for the rest of the market to carry the torch. It has to be, everybody else has got to be involved. Energy, banks, you name it, in the small cap space has to participate. And that's not what we're seeing currently. They had their run, but they're definitely not picking up the bucket if large cap tech is going to roll over here. And we've had a good run.
There's not enough firepower there.
Yeah. And we've had a good run for a little while here. If things cool off, and you can argue they already have underneath the surface, but if the broad markets follow that cooling, that's what markets do best. They fluctuate. You can have a corrective period that isn't a 20%, but it might be something like a 10%, which doesn't feel good either going into the new year. Who knows? We'll let price dictate that. As you started the podcast off with, basically, if the information changes and the opportunities increase of the things that we can add to the portfolio, we'll do it. Not a problem. So I know we were going to keep this one short and sweet just because of our day jobs and the time left to make sure we're doing that appropriately. Anything that you want to touch base on before we close this podcast down?
No, just that, I think I mentioned last podcast, or at least on Twitter, that in our rankings, we had seen a lot of this large mega cap growth float up to the top in our relative strength rankings. And that can be good, that can be bad. And then, again, if we start to see the big ones fall, right, we had Amazon failed again. Amazon took another shot recently at getting above that 3,550 level.
Yeah, it's a big one.
So lots of divergence out there. It's the weakest that we have seen it, I would say, all year.
Yep. And, using something like Amazon, even looking at it on a weekly basis, this thing could be above 2,900, 3,000 for a long time. Could consolidate a long time based on this information, based on, I don't want to call it a double top. It wouldn't be a double top confirmed until it's below 2,960. Mm-hmm. But this, Amazon, one of the biggest names on some of these large cap indices moving sideways just might be hard treading here for a while. But until we get new information, there's weakness underneath the surface. We'll see if that continues broadly. When I say broadly, I mean the large cap indices like the NASDAQ and the S&P 500, we'll see. And there's definitely warning flags between last month's price action, micro caps, small caps, and some of the credit spreads we're seeing. Caution is warranted, no doubt about it. Ian, we didn't get a chance to talk too much Thanksgiving. I hope you had a wonderful Thanksgiving. I hope everybody out there had a wonderful Thanksgiving. Our apologies if we came across too bearish, but the information is information. Nothing we can do about it. If there's more supply than demand, as Ian said, in some cases, overwhelming supply, we have to pay attention to that. So we hope you guys have a great week ahead and tune in again next Friday.
Have a great weekend, everyone.